I am here in Japan, Niseko, and I want to talk about what matches the background, which is the winter, the crypto winter, or the winter in general for any asset class. Now, what's important and what everybody tells you is that we should diversify. We should buy different asset classes in order to reduce our risk. But everybody that's investing that doesn't want to just preserve capital, right? Everybody that's below, say, 60, 70 years old, we actually want to make money. We don't just want to preserve our capital. And so the idea of risk minimization, reducing our risk at the expense of potential returns, doesn't sound very sexy. But it is important if times get quite cold, right? If prices crash. And especially for crypto, we have seen quite massive crashes. And if you look at the stock market, especially compared to, say, the monetary base, we've also seen quite significant crashes. Not just 50, 60%, but actually 70, 80, even 90%. So it's all about how does an asset do relative to the monetary base? And how can we achieve optimal diversification in terms of still getting enough performance, but also in terms of potentially getting more opportunities? Because this is how it all works, right? Nobody can have capital for a very long term in the fiat ecosystem. If we have this for too long in fiat, we get inflated away. Everybody knows that. And so we have to invest in something. And so what happens is people are just shifting their capital from one asset class to the other. So whatever is currently hyped, everybody jumps on that thing. And so people just create more and more momentum. Then everybody buys crypto, or everybody buys silver, or everybody buys AI stocks. And at some point, the last person that jumps on that train, that last person gets slaughtered, right? So it's all about just figuring out where is currently the grand monetary base flowing. People that have saved money, people that have saved their purchasing power, where are they currently putting it into? Because it can't just be in regular fiat currency. So when the money is just flowing from one asset class to the next, when there's simply just trends going on, we just have to figure out what's currently sexy, what's currently trending. And then we have to jump on that trend early enough. And you have to figure out how can we minimize our risk. And so we just rebalance, right? We try to figure out our target allocation. Now, the problem with finding the right target allocations is that most people don't really think about diversification enough. There is this idea of a 60-40 portfolio, right? We put 60% in stocks, 40% in bonds, but everybody knows that this is an idea that's completely outdated. Bonds, very long-term, tend to also underperform monetary debasement. Then there's other diversification methods. Maybe put a third in cash, put a third in property, put a third in stocks, and you're good this way. But really, I don't think that's optimal either, right? Where is crypto? Where are precious metals? In the end, there are 5 major asset classes. And the reason why I differentiate between those 5 asset classes is because those tend to have different risk exposure. They tend to have different long-term returns, but they also tend to have different volatility, as in they're not very much correlated. One thing goes up, one thing goes down, and they don't necessarily correlate with each other that much. And so what's the advantage of property? The advantage of property is that if you've got regular, predictable income, that you can lever up that income to a degree that's not possible with other asset classes. So you can take years of your salary to buy a house. You can lock in the interest rate for a very low rate, and that interest rate can be lower compared to the monetary debasement. So money expands by roughly 6.8% per annum. If you can lock in an interest rate that's below that, then you're making money because the debt devalues faster than the money expands. What's the advantage of a stock allocation? The advantage of stocks is that it tends to keep pace with the 6.8% debasement. So houses tend to slightly underperform by 1 to 2% per annum, but stocks tend to perform roughly 6.8%, potentially a bit more, potentially a bit less, depending on how efficient you set this up. If you've got a low-cost ETF and you avoid taxes, then you're okay. If you pay taxes or if you have a lot of fees managing an actively managed portfolio, then this might be different. Now, what's the advantage of gold? The advantage of gold is that it can be self-custodied, just like Bitcoin. Right? So in case there is a total financial collapse, you've got still some purchasing power that we don't have with any other asset class. Now, we always have to think about valuations as well, right? What's currently worth investing in? Gold, relative to the money supply, is currently very expensive. Stocks, relative to their future earnings, the Shiller PE ratio, is also rather expensive. So we have to think, what is actually worth investing in? To what asset class should we currently be over allocated towards? So I'd make the argument it makes sense to be over allocated towards property if currently interest rates are very low and we can lock in those low interest rates. I'd argue it makes sense to buy stocks when the historical PE ratio, the Schiller PE ratio, is very low. I'd argue it makes sense to buy silver and gold when it's currently not very trendy, which unfortunately it currently is. I'd argue it makes sense to get into crypto when crypto historically is below its realized price, and when it's below the average cost basis. That's when it makes sense to buy Bitcoin. Now, when we look at all of those metrics, unfortunately, they are all quite high. So nothing seems to be really cheap. And so what about fiat then? That's probably, unfortunately, and that's again the theme here of this whole environment, it's probably the place to be. Everything might crash in 2026 or in 2027 or in 2028. There's simply just too much allocation towards volatile assets. And nobody wants to be in fiat right now. And while the fiat base expands by 6.8%, we can get at least partially that expansion back via, say, bonds. Right? We can get our 4-5% per annum, and then the majority of the debasement goes away. We do not make any money, but at least we're not exposed to something that has limited upside with potentially quite a lot of downside. Now, everything that I'm saying here is not advocating to be 80% in one asset class. But I'm also not advocating to be 20-20-20-20 in all of those 5 asset classes. I'm advocating for rebalancing things. And if currently everything seems to be expensive, if gold is expensive, if stocks are expensive, if crypto isn't yet that cheap either, if property can't yet be that cheap because the interest rates aren't yet at the low, then it makes sense to be more than 20% in fiat-related investments. It makes sense to have short-term government bonds. It makes sense to potentially even bet on long-term bonds. And then when the interest rate goes down, get some money that way, right? There's an inverse correlation between interest rates and government bonds. So there is a way to play the game and to still keep purchasing power even through a crisis. And that's really then where millionaires are born, right? It's when you buy at the bottom of a crisis. It's when you get into Bitcoin at the height of the global financial crisis. It's to buy the thing that nobody wants to buy at the time. When people declare you being stupid, that's when you want to get into an asset. And unfortunately, there's very few opportunities right now. We simply should just protect ourselves and enjoy the weather and not be too anxious if we don't make too many investment returns in a given year. Sometimes cash is king, and 2026 might be exactly one of those years. Thanks for watching. Feel free to also join the premium membership if you want to get exactly the same trades that I make. There's an automated copy trading pool over there. That's down below, thebitcoinstrader.com. It should also pop up over here on the screen. And yeah, see you next time on YouTube as well. Cheers.